Hi, welcome to Market in a Minute. As you guys know, I live in Denver, and the Broncos, 2 weeks in a row now. I think they have a really good team, but 2 weeks in a row, they lose right at the end of the game. So they're 1-2. I think they have a really good team, but darn, the luck is just not going their way. So technology, we think is really overheated. Needs to cool off a little bit, or it needs to rotate a little bit. We're hoping the rotation goes down to the rest of the market as well as the Fed cuts rates. But there's some tech names. Tech groups got momentum. I think maybe some of these tech names will catch a little bit. These second-tier companies. They're not second tier. They're first-tier companies, but they're not. They're below the top 10 in terms of technology companies. That's where I think the action is going to move to. The repo market, okay, you may not understand what it is. I need to walk you through this so you understand it. It gives you'll get a little bit of heightened risk understanding of what's going on in the financial markets. It's a little concerning, but I want you to be aware of it. Market opportunities. Okay, so OpenAI gives Oracle an order for $300 billion of services. We kind of thought that was a joke. And then NVIDIA turns around and invests $100 billion into OpenAI on Monday. So OpenAI can buy NVIDIA chips. I'm not sure what this means for Oracle. I guess it's a positive thing. And then what's NVIDIA doing? I know, they're king of the mountain, got plenty of cash. Are they running out of big customers? Or are they having to start to finance their own growth? That is some serious financing, $100 billion investment into your customer. That's a lot of money. Some of the mega cap technology stocks have market caps that fully reflect a lot of the potential of what's going on in these markets. The top 10 stocks in the S&P 500 make up 42% of the index. The concentration of the market, it's not healthy. As you know, there's two times, right? Times in terms of what time it is. Two times. We have stock market time, and then we have real economy time. In stock market time, everything is happening right now, and the next 3 to 5 years might get discounted very quickly. And then real economy time is that 300 billion that they agreed to do with Oracle and a $100 billion investment by NVIDIA. That may take 5 years, but these stocks are reacting basically instantaneously to this information. In terms of tech, 48% of the S&P 500 is in tech and tech-related stocks. That's massive. Okay, so what we're hoping happens is we get some rotation out of those top names over to the rest of the overall markets to let that kind of work work a little bit, let the rest of the market make some money, and or see some of those tech names that are below the top 10 stocks start to do really well as well. So we think there's some opportunity in those other tech names. So we mentioned Marvell, a few weeks ago. We like it. We think it's poised to do very well over the next, say, 3 years, 5 years, something like that. The stock set up, they stubbed their toe a little bit because their main customer kind of moved some orders around. Not a big deal. Stock really corrected on that. We think it's going to come back, and Marvell is an interesting stock to own. Okay, we've talked about that. Stock's moved up nicely since we bought it, so it's something that we like. Now, CRM, Salesforce. Okay, I gotta say, I've never really liked this company because I didn't really like the product all that well. We've had Salesforce at my company. We stopped using it because I thought it was too expensive. Yeah, I am cheap. But what they're doing is their base business is moving towards AI, and they're starting to get into Palantir's business a little bit. So I don't think it's a major threat to Palantir, but it's an opportunity for Salesforce CRM. Palantir has a huge multiple. Actually, Salesforce is a much larger company in terms of revenues, but smaller company in terms of market cap. So uh, Salesforce just recently got a $100 million license agreement from the U.S. Army. They think there's more to come there. They think that their product is much cheaper and therefore a better opportunity for the federal government to be using them rather than Palantir. So that's where sentiment starts to get into Salesforce, or even if they're going to take some market share, you could have a nice move in Salesforce stock. We also want to be in that cybersecurity area. Um, Palo Alto Networks, we like it. PANW, stocks moved up for us. You can see, you go look at a chart for that. We bought it right. CrowdWorks, okay. That's we bought that really well a year or so ago when they had that security issue. Stock got pummeled, came back. We sold it. Maybe sold it a little bit too early. Now we're looking at Fortinet, okay. FTNT. Probably nothing close to being as good a company as the previous two, but there's an opportunity there. Big gap in the stock. Usually those gaps are filled over time. So we're looking at that. We haven't bought it yet, but we're looking at that as an opportunity to give you an example of what to be doing in the technology space. I don't think you could just mindlessly buy NVIDIA and the rest of the large cap technology companies and forget about them at this point. I think there's just too much risk as they're too concentrated part of the S&P 500. Now, Powell did deliver. I was impressed that the Fed came out and said, okay, looks like through their dot plots they're going to cut 2 more times this year. It's always hard to listen to Powell. He's not a very dynamic speaker, but it looks like they're going from 4.5 where they were to 3.75 by year end. That should be of help. Okay, we think that over time they're going to go to 3 or 3.25 in terms of the Fed funds rate. So we think that the strategy here is to buy those blue chip companies that currently yield somewhere around the 10-year Treasury yield, or somewhere around what the current yield is on federal funds rate as that drops. So money market yields will likely come down in time, and those nice yields, those big fat yields on the blue chip companies look really attractive. I want to talk about Kimberly-Clark a little bit. So this is a roughly 1-year chart of Kimberly. You can see here it gets down to about $124. It has these nice rallies to them. This is well over $140. It's done this a couple times. It got to $124 here in August. Pulled back again, $124. On a chart, this is a really interesting point to play it as a trade. However, we think there's more going on than just playing this as a trade. We see their business momentum starting to come back. So internationally things are percolating. The margins seem to be getting better. The stock is trading at a very nice valuation. So this is roughly over a 10-year period. You can see this is 17 times earnings. Here's the red line. You can see it gets down to 17 times earnings and tends to, come back up nicely from that. It's corrected when we've had corrections in the overall market. It's pulled back more than that. You can see, the valuation back in 2018 and 2021 is pulled back to a little bit less than 17 times earnings. But we think that 17 should probably be 20 or more, maybe more in line with the overall stock market valuation, 22 times. That gives the stock a really nice move. Plus they got some momentum coming back to it and a big fat dividend yield. So Kimberly, I like that one a lot. Technicals. So the S&P is now at the top end of the range that we were fearful it's going to get to. It's roughly at 6,700 now. So if you do the math, okay, that those S&P 500 makes roughly 300 or 300 and change next year for 2026, and you can get maybe a 24 multiple on that. That's high. That's really high. That's a similar multiple that was experienced in the year 2000 during the dot-com bubble. Okay, so you put those together, you're at 7,200 100 on the S&P. 24 times the 300 gives you about 7,200 on the S&P 500. We're at 67. So there's roughly 7.6% upside, say over the next 12 months. That's not a lot of upside. So we think that that what's the issue is these high valuations of a lot of these mega cap technology stocks, and some rotation needs to occur to get a decent return. To get a really good return, you got to start looking at just not the indexes itself, but look underneath the indexes to find those interesting companies. Small caps. Okay, so the small cap index this is over a 10-year period. It's back to the old highs. So we hit this 2 other times and it's pulled back. So we think small caps benefit greatly from lower interest rates. And it's popped above the previous highs over the last 10 years, so just a little bit above it. So the question is, does it continue up or do we get a pullback? I don't know. We think over, say, the next 12 months that this index will be higher. Short term's hard to say, but we think it might be breaking out here. It's something to really keep an eye on. As I mentioned previously, over and over again, we really like small caps as rates come down. It's a really small group. Wall Street will pile into it in a big way, and you could see this index a lot higher. But in the short term, got to watch it really closely to see if it can maintain these prior highs. The technology stocks, mention these. Okay, so this is a top end of the channel. You can see the channel here. Okay, the red line, it's popped above that. So we think that the technology group is overbought, and the valuations are high. It's got momentum. Maybe that momentum continues into year end, but there's probably other ways of playing it, just in terms of not just buying the index, but buying some of the individual stocks. Now this is a little complicated, so bear with me, okay? We're going to walk through the liquidity in the banking system, and it's a little disturbing. But first of all, there's plenty of liquidity in money markets, right? Lots of money in money markets. So back in 2000, we were roughly at $4.8 trillion in money market funds. We're up over $7 trillion in money market funds. This could fund the next big rally, and/or the rally back in the blue chips where the yields are higher. If you're a yield buyer, if yields drop quite a bit, you're gonna do like we did in the last cycle. You're gonna buy those high yielding equity stocks, something above 4% or more to get the yield that you're looking for. That's what these buyers have done in the past. I think this will happen in the future. But the Fed has shrunk its balance sheet. And I want to show you the Fed's balance sheet. So this is the history. So back in the financial crisis, we were below $1 trillion. Sounds like such a small number now, right? We were below $1 trillion on the Fed's balance sheet. Then they increase it by $3.6 trillion to roughly $4.5 trillion at the high. So that's a massive move up. The stock market went up 1 for 1 in terms of the stock market going up, the balance sheet increasing, the stock market going up. So the correlation was really high between the two. Again, happened again. So we got down below 4 trillion on the balance sheet, and had COVID, and the balance sheet grew to $9 trillion. Okay, so it went up $5.3 trillion. Massive increase. Stock market followed again, right? Not as highly correlated, but it did follow. And now the balance sheet has shrunk by 3.4 trillion. Okay, this is rather disturbing. The stock market's at all-time highs and the balance sheet's shrinking. So what's going on here? We lost the correlation between the two. This is a rather disturbing what's going on in the repo market. So overnight reverse purchase agreements. So this is what the Fed can show, that this is reports from the Fed. the reverse repos, the repo market had tons of liquidity. Okay, so what's the repo market? This is when the banks have excess reserves and they put them out into the repo market. So the Fed buys these assets, and then they sell them back. So it's a really short-term mechanism of getting some yield overnight in your excess liquidity. So this is the excess liquidity. You see this zero here? That's the excess liquidity. So the repo market has gone basically from 2.4 trillion, plenty of liquidity, down to almost to zero. There's maybe 25 billion that's in the repo market currently. This is rather disturbing if you are relying on the repo market to finance your company or your assets overnight. So another thing to look at, okay, so we got the repo market, since those reserves in the banks are still there, but the excess reserves have gone. So what does the reserves look like? So we have reserves now of 3.3 trillion. Of an economy that's 30 trillion in size, I'd kind of like to have this a little higher. Dips below 3 trillion, I'd be rather concerned about the financial system. So where's this money going? So the bank reserves, okay, all this has been gobbled up by money going to money markets. You can see how aggressive the Fed was. When the Fed tightens or they want to ease, the bank reserves can be part of that. So as you can see, the Fed got really aggressive on growing reserves from roughly 2.7 trillion to 4.2 trillion. Okay, so plenty of liquidity in the banking system. Now the banking system has dropped from 4.2 down to 3. So maybe the Federal Reserve thought this was too low. So you can see the issue here is that the banks have money. Maybe it's not as much money as they like. The excess liquidity has dried up. All this money in money market funds, okay, the Fed's got to be a little bit more proactive. So the Fed has kept rates too high for too long. If they don't really start to move, there could be a problem in the financial markets, in the financial system, in the banking system. So you can't have reserves, turn negative on us, okay? Zero is basically as far as they can go. So this is rather disturbing. It's something to keep an eye on. The balance sheet continues to shrink. That's a problem. Okay, bank reserves need to grow the economy. So we need more banking reserves. To get the banking reserves up, you need these money market funds to turn into just normal deposits to allow the banks to lend that money out. So just keep that in mind, that the liquidity situation is not as bright as everybody thinks it is. We got the stock market at a big all-time high. Lots of speculation in the mega cap technology stocks. I think it's a difficult market. If you understand the risk, you're gonna pull your exposure down here and be a little bit more loss averse. As you know, my company does loss averse investing. The worst thing that could happen to us if we have a big decline, we don't want to go down with the overall markets. We hate to lose money. So our mode is, let's be in a protective mode. We might get a melt up in the overall markets, who knows? The markets may continue to run on a handful of technology companies and push the markets higher. But we think that there's a fair amount of risk. You ought to be aware of it and have a plan of action. So if there's anything we can ever do for you, let us know. Come to my website, Patrick Adams, CFA. Sign up to get a hard copy of Market in a Minute. Has a lot of stats on there. I think that'll help you a lot. And if you ever need any investing, let us know as well. My company is called PVG Asset Management. Take care.